Hey guys, what's up? Welcome back to another video. In this video, I'm going to be doing an intrinsic value analysis of a company that recently announced earnings for the second quarter of 2023, McCormick. And we can see that over the last year, McCormick is up 5%, so they're underperforming the market, which overall is up 17%. So I'm just going to look into some of the recent news that came out surrounding McCormick. I'm going to look into their financial statements, and then I'm going to use a discounted cash flow model to figure out the intrinsic value per share for the company. So right here in this article, it's titled, "Is McCormick Stock a Buy?" And some key points they touch on include the fact that McCormick had a rough year in 2022, but price increases for their products are likely to return the business to a normal footing in 2023. Right here, to start off in the first paragraph, they touched on the fact that sales growth accelerated as compared to the prior quarter. Profitability trends improved as well, despite added stress on the business from inflation and rising costs, which is increasing their cost of goods. Right here for cash and profits, they point out that the combination of cost cuts and price increases allowed their gross profit margin to decline slower than it typically would. Rather than falling 4 percentage points like it did in the fourth quarter of 2022, their gross margin only fell less than 1% this quarter. In terms of outlook and valuation, they point out that McCormick is projecting sales to grow at around 5 to 7% this year as operating income rises 9 to 10%, so their profitability is going to increase even more than their revenue, which is a trend that we'll analyze later on in their financial statements. Also, they touch on the fact that forecasts line up with management's long-term goals for boosting sales at a slightly higher pace than the rest of the consumer packaged foods market, while simultaneously increasing profitability. When you couple their growth also with their dividend payment, as you see right here, then the total shareholder return sits at a comfortable 10% in that scenario. The stock's valuation has declined in recent months, but it still sits above many peers. Investors at the moment who want to buy into McCormick have to pay 3.5 times annual sales for the business, compared to only 2.9 times for some of their competitors like PepsiCo. And then lastly, right here, they point out that the fact that this year's growth is coming mainly from price increases challenges the bullish narrative on McCormick, because they can't continue to raise prices in the future in order to increase sales. Obviously, if they did that, then a lot of consumers would just trade down to less expensive flavorings and spices, and so they would lose customers. So they have to figure out a way to continue to grow their business and their sales without increasing prices. That's the main challenge for McCormick at the moment. And so right here, these are their financial statements. We can see right here their income statement shows that net sales are up year over year from 1.5 billion to 1.6 billion, an increase of 8% year over year. And then net income is up from 118 million to 152 million. So that's an increase of 28% year over year. So their net income obviously increased a lot faster than their revenue did. For their balance sheet right here on page 6, we can see total assets are down from 13 billion to 12.9 billion. And then we can see that retained earnings increased from 3 billion to 3.1 billion, giving them more capital to return back to shareholders if they wanted to. And then lastly, for their cash flow statement, we can see they're comparing the first half of 2022 to 2023. Operating cash flow is up from 154 million to 394 million. So that's a pretty massive increase there. And then if we go down here, we can see their dividends paid to shareholders is up from 198 million to 209 million this year. And they also repurchased $18 million of common stock for this first half, in comparison to the first half of 2022, where they only repurchased 12 million. So they are prioritizing returning value back to shareholders more this year than they did last year. So right here, this is a discounted cash flow model to figure out the intrinsic value per share for McCormick. Yahoo Finance is estimating that the company is going to grow at 8% for the next 5 years at $389 million of free cash flow in their most recent full year, a net $4.7 billion debt position on their balance sheet, and 251 million shares outstanding, which puts their intrinsic value per share at $3.28 per share. Obviously, that means at the moment they're not trading below intrinsic value per share. Their current stock price is sitting at $86 per share, so they would definitely need to trade a lot cheaper based on these metrics in order to be trading at a good buying opportunity from a value investing perspective. Then next, over here, I did a competitor analysis comparing them to two of their competitors, Conagra and General Mills. We can see across the board they have the highest gross profit margin, middling of the pack net profit margin, and then a middling of the pack return on assets. They have the highest price to earnings ratio, so they are trading at a premium compared to Conagra and General Mills. And then they also have the lowest dividend yield. Conagra has the highest with 3.79%. McCormick is only 1.74%. So compared to the competitors, if you're looking at profitability ratios, it looks like they're pretty competitive. But in terms of their valuation, along with their dividend yield, it looks like you probably want to give it to either General Mills or Conagra. And then to end off the video, I wanted to compare McCormick to the other companies we've looked at in past videos. In terms of intrinsic value per share, we saw that McCormick is currently not trading below intrinsic value per share. Google, Alibaba, General Electric, and Etsy are the only companies we've looked at so far that are trading below intrinsic value per share. Over here, we can see from their growth rate, McCormick had an estimated 8% growth rate, not good enough to get them onto the table. Nvidia had the highest estimated growth rate at 33%. For gross profitability, McCormick was sitting at a gross profit margin of 35%, net profit margin of 10%. That means that they're not good enough to get onto either table. Adobe had the highest gross profit at 86%, and Microsoft had the highest net profit at 36%. We can see that in terms of their Q2 revenue growth and their dividend yield, McCormick comes in second place compared to the other companies we've looked at. Kroger is the only one so far with a higher dividend yield at 2.20%. In terms of second quarter year-over-year revenue growth, we saw McCormick increase their year-over-year revenue for the second quarter by 8%. Oracle's for the second quarter of the year was the highest at 17%. For net income, we can see McCormick increased earnings year-over-year by 28%. Kroger was 45%, so McCormick does come in second place there. And then lastly, for stock performance over the last 5 years, we can see that McCormick is up only 44% over the last 5 years, not good enough to get them onto the table. Tesla has the number one spot at a 1,000% return. Last spot goes to Google with 132%. So based on this, comparing them to the other companies we've looked at, I know the companies are from different industries, so it's not really a fair comparison, but I still like to do this comparison for personal use from an investing perspective. Based on this, it looks like they're not really that competitive. The only way they're competitive is in second quarter year-over-year growth, but as we saw from the article, that mainly came from increasing prices of their products, so they're going to have to figure out a better way to increase sales and earnings aside from increasing the cost of their products, because that's not sustainable. For competitor analysis here, we saw that they were pretty competitive and they're about middling of the pack between Conagra and General Mills, and based on this discounted cash flow model, they're currently not trading below intrinsic value per share. So let me know in the comment section down below what you guys think of McCormick. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.